Hello and welcome. Navigating the world of crypto tax in the UK can feel like trying to solve a puzzle in the dark. That's exactly why the experts at My Tax Accountant have put together this essential guide for the 2025/26 tax year. With all the new rules and HMRC's watchful eye, it is absolutely crucial to understand your obligations. So let's just get straight to it.
Right, let's kick things off with the big one, the headline news that could seriously impact your wallet. The capital gains tax-free allowance, it's been slashed, and I mean slashed, down to just £3,000. If you're a crypto investor, what does this mean? Well, it means you're far more likely to be facing a tax bill this year. Staying on top of this stuff is your best line of defense.
So to make this all crystal clear, we've broken it down into 6 straightforward steps. We'll start with what's new with HMRC, then we'll get into what actually triggers a tax bill, how to calculate it, and finally, how to report it. By the end, you'll have the confidence to get your crypto taxes sorted.
Okay, let's dive into Section 1, HMRC's new rules. Look, if you've been kind of treating your crypto activities as something that's, flying under the radar, it's time for a reality check. The taxman is more vigilant than ever before. Here's the thing, HMRC isn't guessing anymore. They have a direct line to your crypto activities. Thanks to data sharing agreements with all the major UK exchanges, they are actively identifying and contacting investors. They've already sent out over 65,000 of those nudge letters. It's a pretty clear signal, right? They've got the data and they expect you to be compliant.
And hold on, because the net is about to get a whole lot wider. Stay with me. This part is a real game changer. A new thing called the Crypto Asset Reporting Framework, or CARF, kicks in from 2026. This means exchanges all over the world, not just in the UK, will start automatically sharing your data directly with HMRC. There's really no hiding anymore, making full transparency an absolute must.
Okay, so we've established that HMRC is watching. Now let's look at what exactly they're watching for. What triggers a tax event? It's a huge misconception that you only need to think about tax when you cash out into your bank account. The reality is, well, it's a lot more complicated than that, and not knowing the rules can be a very expensive mistake.
These taxable events are officially called disposals. Now, this obviously includes selling your crypto for pounds, but that's not all, and here's where most people get tripped up. Did you trade your Bitcoin for some Ether? That's a disposal. Use some crypto to buy a coffee or a new laptop? That's a disposal too. Even gifting it to a friend counts. Each and every one of these actions could trigger a tax bill.
So let's just make this super clear. On one hand, you have the taxable events, selling, trading, spending, and gifting to most people. But on the other hand, some things are not taxable. For example, just buying crypto with pounds, holding on to it, or hodling, moving it between your own wallets, and gifting to your spouse or civil partner. Getting this distinction right is absolutely fundamental.
Right, so you've made a disposal. The next question you've got to ask is, how is it taxed? Because in the UK, your crypto profits can be treated as either capital gains or as income. And believe me, the difference between the two is huge and can have a massive impact on your final tax bill.
This is the key principle from HMRC that underpins everything. They are very clear. Crypto is not money. It's property. You need to think of it just like you would a stock, a share, or even a piece of art. And what happens when you sell property for a profit? That profit is subject to capital gains tax. Simple as that. And just look at the difference in the tax rates here. Capital gains from your investments are taxed at a relatively friendly 18 or 24%. But crypto that you've earned, say from staking, mining, or even getting paid for a job in crypto, that's treated as income. And the tax rates there can rocket all the way up to 40 or even 45%. You can see why it's so important to classify everything correctly. Okay, let's get into the nitty-gritty, actually calculating what you owe. Now, this can seem a bit tricky, but this is also where you can be smart about it. What's really interesting is how these rules can actually save you a fair bit of money if you understand them properly. You can't just pick and choose your cheapest coins to sell first. HMRC has very specific rules you have to follow. So these are HMRC's matching rules, and you have to follow them in this exact order. It's a strict 3-step process. First, you match any sales with purchases of the same crypto made on the very same day. Second, if you have any sales left over, you match them with purchases made in the next 30 days. And finally, anything that's still left is matched against what's called the Section 104 pool, which is basically just the average cost of all your other holdings of that same crypto. Remember, you have to follow that order. It's not optional.
I know that sounds complicated, so let's make it simple with a real-life example. Let's meet Aisha. She's a freelancer based in London. She dips her toe into the crypto market and buys 1 Ethereum for £1,500. Let's see what happens next.
So a little while later, the value of Aisha's Ethereum has gone up. Great news. She decides to sell it for £3,000. In the language of tax, her proceeds are £3,000 and her cost basis is the £1,500 she originally paid. Those two numbers are all we need.
To work out her capital gain, we just do a simple bit of math. Subtract the cost from the proceeds. 3,000 minus £1,500 gives us a gain of £1,500. Now, because this is well below her £3,000 tax-free allowance, Aisha won't actually owe any tax on this specific sale, assuming, of course, she has no other capital gains during the year.
And here's a quick pro tip for you. Actually, 2 of them. You can use these to legally minimize your tax bill. First, you can offset any of your gains with losses from other crypto sales. This directly reduces the amount you're taxed on. Second, you can gift assets to your spouse tax-free, which lets you use their £3,000 tax-free allowance as well. That could potentially double your household's tax savings. Pretty smart, eh?
Right, you understand the rules, you've done the calculations. What's next? Well, now we have to talk about the practical side of things, actually reporting all this to HMRC. This section is all about the exact forms and dates you absolutely need to know.
Everything gets reported through your self-assessment tax return. For any crypto income from mining or staking, that goes on the main SA100 form. For your capital gains and losses from disposals, you need the supplementary SA108 form. And here's the crucial update. The SA108 form now has its own dedicated box just for crypto assets. If that doesn't show you how seriously HMRC is taking this, I don't know what will.
So, get your calendar out and mark these dates for the 2025/26 tax year. The tax year itself ends on April 5th, 2026. If it's your first time filing, you must register by October 5th. But the big one, the one nobody can miss, is January 31st, 2027. That's the final deadline for online returns and for paying any tax you owe. Don't leave it to the last minute.
We have covered a huge amount of ground, and for some of you, this will be enough to get you on the right track. But if you're sitting there feeling a bit overwhelmed by all the rules and calculations, honestly, you are not alone. Getting some professional help can be the smartest thing you do.
And it's completely understandable if you are feeling a bit overwhelmed. Crypto tax is a really complex, fast-moving area of tax law. The calculations can be a nightmare, and let's be honest, the consequences of getting it wrong can be pretty significant. Seeking expert guidance isn't admitting defeat. It's a really smart move.
The team here at My Tax Accountant are absolute specialists in this field. They can handle all the complexities for you, making sure you're not only fully compliant with HMRC, but also as tax efficient as you can possibly be. If you want to take all the stress out of your crypto taxes, I highly recommend giving them a call.
And just before we finish, a very important disclaimer. The information in this presentation is for general guidance only. It should not be taken as financial advice. For help that is tailored to your unique situation, you should always consult with a professional tax expert like the team at My Tax Accountant. Thanks so much for watching, and don't forget to subscribe for more insights on tax and finance.